Okay, so following on from the first video on stop loss, this is basically going to be trade management. Trade management is basically an area of trading that I think is often overlooked, but it should be, again, as mechanical as possible, just like how I've gone over with the stop loss video. And I think that with trade management, if you can make it as mechanical as possible, then again you're taking a lot of decisions out of your mind. Of course, there is like expert advisors that you can use on MT4 and robots, etc., that can do it automatically, which I would also suggest if you're able to do that. But if you're not, then you've got to make it as mechanical as possible so that you can concentrate on other areas of trading that are hard to make mechanical if you're not using a robot, if you're not using something that is trading for you, like entry requirements, etc. They are hard to make mechanical because of the nature of the market. Nothing's ever perfect. But if you can have an area that you're like, well, in general, I will enter around here if I can get a certain kind of reaction. I will put my stop loss here. There's no question because of the type of trade that I'm taking. And these are my management points within the trade. So every trade, so if I'll just do the same as what I did with the other video. So every trade, let's just type, every trade I have around 3 management points. If it goes beyond the third one and I'm still in the trade, then I mean that's a bonus. I'll then, if I need to calculate the one beyond the third because the price gets there, then that's what I'll do. I'll then look to sort out another 2 or 3, but that's usually by the next day anyway. So it's just kind of a case of, right, well, here's the next logical areas that make sense. So it's very rarely less than 3, and sometimes more than 3 that I'll sort out. So the first area is usually the opposite side of, so let me just write this out. First area is usually opposite side of structure, origin, well, immediate structure. So immediate structure on the 1 hour, 4 hour, depending on the trade. So I'm just typing this out rather than having it already, because I feel that whenever I've watched videos in the past, whenever someone's like typing it out whilst they're talking about it, it makes me remember it more. It makes me write down notes to then take that into what I'm doing. So I'm hoping that you're doing the same, basically, wherever you're watching this. The main reason that I'm doing this series and the main reason why I'm putting it all together is just to try and create something that stands the test of time, that can be used by people that want to see the market in a similar way to me, trade the market in a similar way to me, but just want a refresh. It's basically a series of videos that I wish that I had seen a lot sooner in my journey. Now, it's a bit like trading in the zone. The more that you read it, and at different points that you read it, it kind of means a different thing to you. So I feel that this series can be the same. You're watching this, and then maybe in a month or 2, you'll watch another video in the series, or you'll watch this one again, and you'll then pick up different points, or you'll look at things slightly in a different way because you've applied some of what you've learned to then try and get better, and then you've got better, and now it's about the next stage. So first area is usually opposite of structure or the origin of the pullback on the 1 hour. The second area is usually the current low or high, depending on direction of trade that you're taking of the day. So that's something that I go over, that I'm someone that likes to trade back into what the current high or the current low of the day is, because you're working with very recent data. You're working with what should be a pretty clear trade. You don't have to think of too much. It's just a case of, right, well, if the trade makes sense, take the trade. Like, for example, here, you've got the resistance structure here. I actually got stopped out by this wick here. I looked for shorts in this area. I put my stop loss above the highs of the 1 hour, as my video says. And I actually had 4 hour protection as well, because we were up at the highs of the previous 4 hour. And I got taken out. Now, there was a re-entry. I didn't get in because I wasn't at the charts, but the whole point of this was that the first main management point was down in this area, which is also the area that was the lows of the day at the time, which we didn't make a new low of the day, but we came into the bodies. Now, you're entering up at 1.6554, and you're taking most of your position off at 1.6520, and your stop loss is 65, 66. So 10 pips, 11 pips stop loss for a good 25, 26 pips to the downside. So again, that's a 1 to 2 trade in a couple of hours. Now, it's nothing fancy. Okay, this time I got stopped out because of the large wick, and it happens, but we took out the highs of this previous 1 hour and then dropped again. So there was a re-entry opportunity, and that will be another topic that I discuss. But that's the premise of my trades. I have my stop loss figured out before I enter. I have my 3 management points figured out. They're all pretty self-explanatory. It's like, well, first area, usually opposite side of the structure, origin and pullback. So something like you have the trend, and then you pull back, and then you drop again, and then you pull back. And obviously, again, the main target is going to be the origin of that pullback. And then if it goes further, it goes further. And obviously that's extra pips for you. So great. And that comes from taking trades that are in strong momentum, etc., that you all know if you're watching this. So the third area is usually kind of 4 hour structure that is to do with the medium term, or usually 4 hour structure, or the previous day's high and low, depending on the way you're trading. Because again, there's a reason why price stopped at those areas to then make that the low or the high of the previous day, because price didn't want, like, the buyers or the sellers didn't allow price to go any further than that. That's why the high of the day is what it is and the low of the day is what it is, because it couldn't go one pipette further. It couldn't even, never mind a pip. There was just a brick wall that was created at that moment in time that price did not go beyond. So usually whenever those areas are hit again, especially for the first time, there is some kind of reaction that whenever you're day trading, that is something that is going to affect your trading. It's practically a no-brainer that it's going to affect your trading. It's going to affect your trade, because it usually the pullback after it's hit the previous day's low or previous day's high, it's going to be for at least an hour or so, which is then going to be back into the direction that you're opposite to where you're looking for the trade to go, therefore taking pips. Whereas if you knew your areas properly, and that's something that I constantly say to the guys and girls that I work with, that if you can get your 1 hour and your 4 hour spot on analysis wise, which is another video, your stop loss placement as mechanical as possible, your trade management reasons as mechanical as possible, and just follow it, you're going to have a much better time with trading because you're sticking to a plan, you're focused on it, and you're just doing it day in, day out, and you're not having to overcomplicate things. You're not having to think, right, well, for this trade, I'm going to do this, or this trade, I'm going to do that. It's like, no, I'm just going to stick with this. It works consistently over time as long as you're taking the right kind of trades. And that to me is the main thing. That to me is what trading's all about, rather than trying to get that one trade a month that could cover all your break evens and losses. Just focus on taking 1 to 2, 3 trades a day that are solid trades that you feel should at least get to your first/second area of management, and then anything else beyond that is a bonus. And with Forex as well, you don't usually get as strong trending in one direction as what you would do with stocks or whatever, because the whole point is it's a country's economy. So it doesn't make sense for a country's economy to crash all the time. Therefore, the likelihood that pullbacks are going to occur and likelihood that pullbacks are going to be deeper than other markets is true. That's why what happens in the Forex market. You've got the high and the low of the day, but usually within that, price is hitting those areas a couple of times because of pullbacks, because of taking profits, etc. Because you can't really have price moving more than 1% from the open too often. Like 1% from the open 2 or 3 days in a row, and it's making public news and things are getting a bit crazy. So you have to keep that in mind as well and be like, well, I just take the profits that the market gives me. I can always re-enter, and it works out eventually on your side that you're taking profits consistently with the right kind of trades. You can make trading work. So I know I've been baffling on a wee bit with this video, but that is essentially trade management points. You'll see me talking about them in trade videos, in the course. That's what it is. And just create a checklist. Create a checklist with stop loss for different types of trades, management points for different types of trades. Well, they're essentially the same no matter what type of trade I take. They're essentially the same. And run with it, see what happens, and let me know. Let me know if you've found it useful. If you have, then drop a comment, give a like, send me a Telegram message, whatever. And yeah, subscribe and watch the rest of the series, and hopefully you get something out of it that you can take into your own trading on a daily and weekly basis.